Welcome, everyone. My name is Gretchen Schmitz, and I'm with Transition Advisors. Our webinar today is What's Wrong with Your Owner Agreement? Before we begin, we need to cover a few very important items. First, please close all other programs running on your computer. This will help ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. In order to receive your 1.2 CPE credit, you must complete two requirements. First, you must participate in all 4 polling questions throughout the presentation. Please note that GoToWebinar does monitor your participation. Partial credit will be given for those answering 3 of the 4 polls. Next, you must complete an online evaluation that will appear on your screen immediately after the end of the webinar. Please do not close your browser before completing this survey. Once these requirements are met, the certificate will be emailed to you within 10 working days. In order to fully participate in the webinar, please familiarize yourself with your GoToWebinar control panel on the right-hand side of your screen. The orange arrow on the top of the control panel is to minimize the control panel. During the presentation, all participants are muted, but you can communicate with us by using the question box towards the bottom of your control panel. Just type your question in the box and click Send. Terry will also be sharing his webcam during today's presentation. You are welcome to resize, minimize, or even close this if you wish. The presenter will answer all your questions during our presentation with time allowed, and we welcome your participation. Here you will see a list of our upcoming CPE webinars. In June, mergers, who to merge with, why, when, and what is success. August, should you sell, merge, or do nothing. And October, how to admit new partners. You can register for these courses on the CPE courses section of transitionadvisors.com. As a reminder, you will receive a link in the reminder email to download a copy of today's presentation. I'm sending the same link just now through the via the chat function of GoToWebinar. Now I'd like to introduce our presenter for today's session, Terry Putney, CEO of Transition Advisors. Thank you and enjoy the webinar.
Thanks, Gretchen. I'd also like to point out with respect to upcoming CPE that if you go to our website, you'll find a lot more courses listed than what I've listed on this slide. Most of the other courses listed are in conjunction with CPA Leadership Institute. We are partnering with that organization to present a significant number of additional CPE courses. If you're interested in participating in those, there is a fee associated with it. It's not very much, and it's why I didn't include those on the slide, because we are not the sponsoring organization on those. We're just the presenter. And all of those courses will be taught by my partner, Joel Sinkin. So I encourage you to look at the website and see if there's anything of interest to you on that. A little introduction about Transition Advisors, if you're not familiar with us. We are a national consulting firm. We work only with CPA firms, and we only work on issues associated with the ownership of CPA firms. That falls into 2 general categories. One is mergers and acquisitions, and we're involved heavily with that. Probably represents about 80% of what we do. Our support for that is finding the parties, making introductions, participating in negotiation and structure of the deals, and then also any kind of transaction support. We also support transactions where we're not the introducing organization. So if you find your own deal, either as a buyer or an upstream merger or seller, we're able to support those transactions as well to help the parties find mutually beneficial outcome. And then in the area of practice management, most of our focus is on succession planning for partners and owner agreements, which is what we're going to talk about today when we talk about what's wrong with your owner agreement. And there is something, at least one thing wrong with your owner agreement, I can almost guarantee it, which is probably why you're here today. So when you look at an owner agreement, and by the way, the deck copy that Gretchen has made available to you is slightly different than what I'm going to use. I've kind of added a few slides here in the last few minutes, so but the bulk of what we're going to talk about today is in the copy that she sent you. When you look at, and this is a slide that I added today, by the way, when you look at your owner agreement, it's actually a tool, and it's a tool used for these basic purposes within primarily your ownership group. Governance, of course, which, how do we make our major decisions? How do we make any decisions in our firm? Is usually detailed out in your owner agreement. That can range anywhere from, what we do on a who makes the decisions on a day-to-day basis to run the organization, and who would make the decision for major issues such as, are we going to merge into another firm? Are we going to acquire a firm or admit a new partner, and so forth. Of course, owner agreements are often used for the determination of owner's compensation. I've seen agreements where the entire owner compensation system is outlined in a formula in the agreement. I don't recommend that's what you do. I mean, I think owner compensation should be dynamic. It should be reflective of what your current situation is in your firm. But if you feel the need, you can include it in there. Usually when I'm involved in structuring an owner agreement, and I've been involved in over 100 of those engagements, by the way, I would usually make very vague reference to an external system or document that's used to manage owner compensation, so that we don't have to make modifications to the agreement itself on a regular basis in order to change owner compensation. Of course, an important component with an accounting firm or most any professional services firm is controlling who can be an owner in the firm. Generally, we're talking about people that are actively involved in the operation and provision of professional services within the firm. Normally, most accounting firms would not have a passive owner, and certainly would not have one that is passive and not a CPA. So, usually an important part of the owner agreement is deciding who can be an owner and when the termination of an ownership needs to occur because of a change in employment status. Of course, managing owner terminations, and there's 5 different kinds of owner terminations that we're generally talking about here. The one that you hope you're going to use your owner agreement for is a normal retirement of a partner. But of course, death, permanent disability are 2 more kinds of terminations. And then, your agreement may stay silent on this issue, but certainly firing a partner is an option in most firms. And a partner quitting, other than through a normal retirement, is also an option. Each of those 5 kinds of terminations actually carries with it a different kind of risk and a different kind of circumstance, so it should be dealt with normally separately and distinctly within the agreement. Raising the capital necessary to run the firm is an important part of the owner agreement as well. Most firms do it through retention of earnings and by asking new owners to make contributions of capital. For instance, as your accrual basis balance sheet increases at a greater rate than your cash basis equity, that difference represents earnings the firm has made or created that are normally retained within the firm, and that's a form of capital. We'll get into dealing with that a little bit in just a few minutes. And then, of course, motivating owners through providing value to them when they terminate. Most of us wouldn't want to go through what it takes to be an owner in a CPA firm or any business if we didn't see something at the end that was going to provide us value that would reward us for the risk and for all the effort we put into it. So defining what that value is an important part of an owner agreement as well. The number one issue in the profession right now, and one of the most important things you can use your owner agreement for, is to manage partner succession in your firm. As I said, I've worked on well over 100 of these types of engagements over the years. And normally when a firm comes to me and has a need for me to work with them on their owner agreement, the thing that they tend to define the problem as is that there is unaffordable terms within the agreement. So everybody, the older partners, the ones that might be retiring soon, will tell me that their concern is that they're not going to get paid by the younger group, and the younger partners will tell me that they don't know if they can afford to make the payments. As we dig into the situation, it's almost invariably what wasn't stated was we don't really have necessary talent. They're not developed far enough for us to sustain the firm in the long run. So the older partners are saying, when they say, look, I don't know if I'll get paid, what they're really saying is, I'm not sure this group is ready for me to leave and to replace me, and I'm not sure we've got enough talent on the bench to replace myself and future partners that'll be leaving. And the younger people are basically saying the same thing. So it turns out that your owner agreement really is kind of irrelevant to the issue if you don't have partner succession dealt with. We're not going to have time today to deal with that specifically. We're going to deal more with the financial issues within your owner agreement. But keep in mind that behind all of this is the need to have a strong partner development program that will provide a constant flow of new talent into the firm in order to make your owner agreement really mean something. So the issues we're going to deal with today are, what makes the retirement payments or the buyouts of partners unaffordable, what makes them affordable, and how to use your owner agreement to manage the transition of retired partners, and then some other miscellaneous issues that we'll get to in the end, which we find tend to get in the way of an effective owner agreement. I'm going to use two perspectives today as we look at an agreement. One is a comparison to similar firms within the profession. That really is a guide. When I say to you that under the Rosenberg survey, which is one of the surveys I'll make a reference to, and I believe is a very useful survey. I recommend it, by the way. We're not involved with them other than I usually provide comments at the beginning each year to their report. But the Rosenberg survey would say that, the multiples that firms are using to define the goodwill portion, the intangible asset portion of their buyouts ranges somewhere between 67 and 80% of revenues based on their survey. That's an important guide. It doesn't mean it's wrong or right. When you look at your agreement and you're significantly different than that, that's something that ought to maybe cue you in that there might be a problem, but it doesn't mean that you have to default to those answers. The other way to look at your agreement is the internal metrics and the economics. What makes about the way we are organized, the profitability of our firm, what makes it our agreement either affordable or unaffordable? And we're going to kick right into a polling question. I've got 4 of these to go through, so we need to get to them fairly quickly. Gretchen?
Okay, this is our first polling question for the webinar. How many equity partners do you have in your firm? Your choices for answers are 1, 2 to 4, 5 to 9, 10 to 19, or more than 20. Just a few more seconds here. Voting is going quick this morning. Okay, we'll go ahead and close this poll.
And the responses were? I can't.
I'm trying to find that. Yeah, it went back to the polling question on my screen. I don't know where the answers went.
We're using
61% for 2 to 4.
Okay.
22% for 1, and 4% for over 20, and 9% for 5 to 9.
Okay, very good.
So your majority is 61% 2 to 4.
Gives me an indication of the makeup of our audience. Thank you. Okay, so let's talk about affordability. So the concept here that we're dealing with is when we decide whether an agreement is affordable or not, is we're wanting to make sure that we reward a partner that's retiring fairly for all the sweat equity, all the buildup of value that they've helped create over the years, but at the same time, expecting those that are left behind, the ones that will be making the payments, not to borrow or take a step back in compensation in order to make those payments. So for instance, if the only way we can afford to make the payments is to go to the bank and borrow money, most accountants would find that to be unsatisfactory. There certainly are a lot of firms that I've run into that use debt as a means of financing their organization. And if they're using that in order to finance negative cash flow, okay, that's a choice they've made. But usually that's not the outcome that most firms would want to get to. And if the other choice, of course, to not borrow, to avoid borrowing, is to just make less money. And both of those would tend to make people unmotivated to carry out the plan. So when the way to look at how we meet those objectives, the affordability objective, is to consider that when a partner retires from your firm, they're leaving behind their compensation. If they made $300,000 and that includes their fringe, the direct fringe benefits, then that's the total available capital that you have to accomplish three things. The first thing you've got to do is replace the partner. Somebody's got to do what that person was doing. We're certainly not going to replace a $300,000 partner with another $300,000 partner, although hopefully there's somebody in the firm that can still do what that person was doing. But somebody's got to replace at least the productivity of that partner and some of the other duties. So we need to assess what the cost of that is. And then what we have left, then we need to do two things with. One is make the payments to pay them off. And secondly is to leave enough behind so that the remaining partners feel like there's something in it for them as well, so that we're not spending the next 5 to 10 years running in place just paying off retired partners. When I hear that that's the situation, the partners tend to say, I'm not really in for that. And as you assess the affordability, keep in mind that you're dealing with two pools of value. So when we talk about a firm being worth some percentage of revenues, say we say 1x, what we're talking about is the intangible value of the firm. So that's the value associated with the book of business, with the client list, with the goodwill, however you want to define it. And there's generally three different ways that most firms define the intangible value in an owner agreement. One would be the book of business method, to say each book of business has a distinct value, and if we threw all those books of business together, we have the total value of the firm. Another is a multiple of compensation, which is what tends to be used in more and more often in larger firms. So if we say that 3 times compensation for a partner, average compensation, say over the last 5 years, is the value that partner has associated or allocated to them. That's another way of defining total value. So the total compensation times that multiple would be the total compensation of all partners would be the total value of the firm. So incidentally, most firms would have somewhere around 33% of revenues that would be the partner compensation in total. And if we take 3 times that number, which historically has been the multiple used, you end up with basically 1 times revenues. So that's just it's a proxy for what historically has been a valuation metric for accounting firms. And then of course, the more common method used in smaller firms is the equity system, which says, I own X percent of the firm. We've somehow come to that conclusion. And that equity times a theoretical value for the whole firm, which is oftentimes defined as a multiple of revenues, is the value that I own. The other pool of value, of course, is your tangible value, and that's normally the accrual basis capital. Now, not every agreement will distinctly call out both of these values. I've seen agreements that just place the value for a retiring partner at only the tangible accrual basis capital. In fact, I've seen agreements where the only value is the cash basis capital. And I've seen agreements where the intangible value, a book of business, or a multiple of compensation, or a multiple of equity, is the only value a retired partner is due, and there's no specific value associated with the tangible value. It doesn't mean that those assets don't exist. It just means that we're not defining the overall value using those assets. So when you look at an agreement that, for instance, that says we're going to pay you 3 times comp over 10 years and nothing for your accrual basis capital, that might be equivalent to really pay another firm that would pay 2.5 times comp plus accrual basis capital. Okay, I'm going to kick into another polling question because we got to make sure we get through all four. We're back to you, Gretchen.
Okay, the second polling question. Does your firm have an owner agreement? Your choices for answers are yes, and it is signed by all owners. Yes, but not all owners have signed it. No, but we need one. And no, we aren't sure we need one. We'll just give a few more seconds here. Okay, I'm going to go ahead and close this poll. Your responses are 50% say yes, and it is signed by all owners. 23% say both, no, we need one, no, we aren't sure we need one. And 5% say yes, but not all owners have signed it.
Okay, so let me tell you why you need one if you're not sure you need one. I'm not going to spend a lot of time on this. But one of your partners gets hit by a bus, and all of a sudden you've got an estate attorney someplace who's deciding for you what you should pay that partner. And they go to the courts and they hire an expert witness, and the expert witness comes up with this ridiculous number, and I've seen it happen over and over again. And all of a sudden, not only are you dealing with a valuation that's probably too high, but terms that are unaffordable. So, that you may say, we're not sure what we're going to do in a normal circumstance, but circumstances might take over and cause you to be in a situation you wouldn't want to be in. So you wouldn't tell a client in a multiple owner firm not to have an agreement. You probably should have one for yourself too. Okay, let's use an example and we go through what can happen to the terms that would make an owner agreement unaffordable. So in this example, throughout these examples, we're going to be dealing with Charlie, I'll call him Charlie here, who makes $380,000 in annual compensation, and that includes benefits, the normal benefits, like depending on what kind of entity it is, it may be payroll taxes or not, it may include 401k matches, it may include health insurance, and so forth. And so Charlie also generates about 1,300 billable hours at $300 an hour, so that's a total of $390,000. And that's what we're going to use to define what it's going to cost to replace Charlie. So we're going to assume 40% of Charlie's production is what we would have to pay somebody off the street to produce 390,000. Now, in most cases, that might be 2 or even 3 people, but roughly about 156,000 in compensation and benefits to replace about 390,000 of annual production. Charlie's accrual basis capital account is 250,000. It may not actually be a capital account. It may just be only shown as cash basis capital, and we may be just allocating the receivables and work in process and other accrual basis items on some other based on ownership or something. And in this case, we're going to assume that the firm uses the equity system for allocating ownership, and so Charlie owns 25% of the firm, and the firm's a $4 million firm. Okay, let's show what can happen here. So here's a set of terms that I'm going to show you are unaffordable. But you might look at them and say, why are those unaffordable? Because this looks pretty similar to maybe a deal you've done where you bought a sole proprietor out. 1.1 times fees right now is pretty high on the marketplace, but a couple of years ago that wasn't so high. Certainly valuations are coming down, but we're going to say 1.1 times fees, and I've seen agreements that are as high as 1.5 times fees on owner agreements. So there's a lot of agreements out there that are still over 1. So in this case, that means that we're going to take 4 million times 25%, which is Charlie's ownership, times 1.1. We owe $1.1 million to Charlie for his intangibles. The tangible value, as we stated, was $250,000. Just because, this is what we've seen done on the street. We're going to pay Charlie out over 5 years for his goodwill, the intangible portion. And we're going to say, look, the the accrual basis capital belongs to Charlie, right? So let's give it to him. We're going to take it. We're going to pay that out by the end of the year. So those terms look like this. Remember, we go back to our affordability test. Charlie's making $380. We decided it's going to cost $156,000 to replace Charlie. So that leaves us with $224,000. It's $220,000 a year for 5 years to buy him out on his intangible portion. That leaves $4,000 left, and we still haven't paid him his capital account, which is another $250. So the first year, the firm's going to have to come up with $246,000. Now, how do they do that? Well, maybe they ask the partners to kick in the $246,000 because that capital in effect is going to go to their benefit. Or maybe we've just admitted some new partners and we've asked them to make capital contributions for to the tune of $246,000, which will help, buy out Charlie's capital. But we still have a situation here where the intangible portion is eating up virtually all of the available capital that Charlie left behind, which means that regardless of what we do with the accrual basis capital, the partners in this firm are going to basically be making nothing over the next 5 years while they're buying out Charlie, and there's no cushion. There's no cushion for anything to go wrong. If the replacement cost ends up being higher or we've got some downturn, this is really cutting it pretty close. So let's look at how we could make this set of terms affordable. So using the same basic set of circumstances, let's deal with the multiple and let's put it at 1x. Now I will tell you, as I told you before, that right now multiples on internal buyouts are running between 67% for the largest firms. Those of you that have 20 or more partners, that's probably what you're looking at. 67%, it can be defined as a multiple of comp, which probably puts it between 2 and 2.5 instead of 3. But in this case, so that we don't get too carried away with that being the only issue, we'll use 1x. The tangible value is still the $250,000, but we're going to use a 10-year payout for both of those items. So going back to the same calculation, you can see where we now have $100,000 payout per year for intangibles, $25,000 for the tangibles, for $100,000 for intangibles, leaving a residual of $149,000. And that's actually a pretty darn good arrangement. My rule of thumb is once you take the $380 and you subtract the replacement cost, and of course that's a hypothetical replacement cost. You've got to decide for yourself what that should be. But I think a good rule of thumb is to use production because you've got to at least produce or replace the production. That leaves $224,000. If you can get to at least 50% of that 224 as a residual in your calculation, then I think you've got an affordable deal. So that would be 224, 50% of that's 112. So 149 certainly meets the test. And just so I can get these out of the way, we got one more polling question here at the moment, and then we'll get back into the presentation. Gretchen?
Okay, this is the third polling question, and just a reminder, you'll need to answer all 4 to get the full 1.2 CPE credits. 3 will get you a partial credit. Number 3 is how many partners in your firm will likely slow down over the next 5 years? Your choices are none, all, most, or some. All right, just a couple more seconds here. I'm going to go ahead and close this polling question. And the responses are 42% say none, 42% say some, and both of the others, all and most, are 8% each.
Okay. The reason why we use the term slow down instead of retire, when people say retire, they immediately think of, I'm out the door. I'm no longer working. Either I did that voluntarily or involuntarily because of what our agreement said. And the reality is that more and more what we're seeing are partners that actually retirement means relinquishing ownership in the firm, relinquishing being paid as an owner in the firm, but many firms are allowing partners to continue working and on a part-time basis as a per diem type partner or a non-equity partner or something like that. So I think that the term slow down is actually what we're seeing. It certainly covers, you could slow down to zero, but it covers retirement, but it also covers what we're seeing happen frequently with firms now. If you're having trouble dealing with partners in your firm that don't want to leave, but you're feeling like, well, we really need to deal with their ownership, think of trying to find a compromise like that, and we can certainly help you. I've noticed that no one's, at this point, we don't have any questions in the chat room. Feel free at the end of this presentation, in the next few days, whatever, to send me an email. If you have a question specific to your situation, I'd be happy to answer it. If that leads to where we help you do something, great. If I can answer it quickly and that's all you need, that's fine too. So don't hesitate to say, hey, what about this? What about us? Okay, so one of the other issues we run into is when, the terms of the agreement make sense based on what we just went through, but the compensation percentage or the allocation of compensation is completely different than the allocation of value. And again, this is a byproduct oftentimes of using the equity system. So it's not unusual for a founding partner, for instance, to, started the firm, built it up to whatever, and started bringing in new partners. And because he wanted or she wanted the new partners to come in a way that was affordable, and because they weren't going to use equity for anything other than, once somebody got bought out, they brought them in at, a low equity percentage. So let's say we started off as $1 million firm, the founding partner got it to that point, and then over the next, 10 or 15 years, we brought in 4 new partners. Each of them got 5% equity. They paid a pittance to get their 5% equity, and that's where we are. And everybody's happy because that's not how we define compensation. So the founding partner, maybe has 80% of the equity, but only gets paid maybe 40% of the total partner compensation. And everybody's happy because that makes sense. That seems fair to them. But here's the problem that creates. So in this case, Murray, that's this guy that we just looked at was Murray, is making $600,000. The same production that Charlie had, $156,000 cost. So now we have a lot more to work with. Of course, we've got $444,000 of capital to work with. But the problem is Charlie, as you recall, owns 80% of the firm, and we're dealing with a 1x multiple. So now we owe Charlie $3.2 million, and we're going to pay it over 10 years. That's $320,000 per year, and we owe Charlie 80% of $1 million of accrual basis capital. That's $80,000 a year for 10 years. So the terms are quite fair, but we just don't have enough compensation to fund this buyout, and we only end up with $44,000 of residual if you do the math here, which isn't enough. This is a problem we run into in external deals too. If this firm was to merge upstream and Charlie expected to get paid like that, there's several problems that's going to create. A buyer or a successor firm is going to look at this and go through the same calculation and say, not sure I'm up for that. And the other thing that of course does is it doesn't leave enough equity behind for the other 4 partners who want to come in as equity partners, but really aren't contributing very much in the way of equity to the firm, so to the successor firm. So this is a problem. The only way to fix this, of course, is to recognize that Charlie's 80% maybe isn't worth 80% times 1x. I ran into a situation like this recently with a firm. This is a real live situation. It was a $7 million firm. The founding partner I think owned 80 or 85%, I can't recall now, of the firm, and was making a fairly high number. I mean, in his case, he was making about $1 million or $1.2 million in compensation. But when you went through the calculation of what it was going to take to buy him out, there was no way that we could afford to pay him based on his 85% ownership. And so we ended up, in this case, actually, oh, and the other problem with this case, and we'll get into it in a second here, is that he produced about 2,000 billable hours on his own time. So the cost of replacing him was extremely high. And as a result, we ended up paying him a valuation multiple of under 50%, was the only way we could make it work. And he was fortunately very generous and was okay with that. Now, another problem we run into partners who say, look, I've been here for a long time. I think I ought to get a little bit of, post-retirement compensation. I'm going to hang around in an undefined manner. If the post-compensation compensation is part of the replacement cost, we go back here, the $156,000. If we were paying this person, say, a third of their billable time, and they were cutting back their billable time to say 400 hours a year, then we could say, yeah, we can afford to do that because we've set aside $156,000 replacement cost, and they're part of the replacement cost. But in the case of $125,000, where there's an undefined role and it's not associated with that replacement of their production, this just makes the problem stronger. Even though the $125,000 might not seem like much for somebody who was used to making $600,000 a year. That's another thing to avoid. Just make sure that you've got, if you do it, try to make sure you define the duties, try to make sure that they actually are creating value. And if they're not, you really need to consider this really part of their buyout. Another issue we run into, people say, how come we're not getting interest on the deferred payments? When you add 6% interest to the payment stream, you're adding 33% to the total value of the payments. I'm not saying that interest shouldn't be there, but when you compare a firm that pays 1x with no interest to a firm that pays 1x with interest, the second firm is really at 1.3 multiple. It's very rare in external deals for interest to be paid on top of whatever the payment stream is going to be. And if it is paid on top, it's typically it means that there's going to be a reduction in the multiple. So for instance, there's a large regional firm we work with that is paying 6% interest on their deferred payments, but they're offering a multiple of 60% to 80% typically on their deals, which converts to a multiple of about 80% to 1x for firms that would be paying no interest. So give you an example of how this works. We're back to Charlie's example, $380,000. If we were paying 6% interest on the intangible value, we're now, instead of paying $100,000, we're paying $133,000 a year. And instead of paying $25,000 for the accrual basis, we're paying $33,300. So all of a sudden, we've turned Charlie's deal into an unaffordable deal. Payments treated as stock. If you're in a corporation, especially a C corporation, it's a pretty difficult situation to be in when it comes to trying to find a tax favorable way to buy out a partner. If you're in an LLC, treated as a partnership, or an LLP, then you can use 736B treatment for the payments, which in effect allows you to buy the goodwill that's allocated to that partner and treat the deal as a capital gain for the partner, and then of course creating an amortizable asset for the partnership. But if you're in a corporation, you don't have that option, unless, we'll get into just a little bit. We'll talk briefly about personal goodwill, but in most circumstances, personal goodwill would not be an option. So in a C Corp, sometimes, in order to create a favorable deal for the partners without thinking it through, they'll come in and say, let's do this as stock. I ran into a circumstance recently where the firm's owner agreement established the value at 1.25 times with 6% interest and treated as stock. And when I told them, effectively what you're valuing the firm at is over 2 times, they, needless to say, understood why their deal wasn't going to work. In essence, when you treat the payments as in a non-deductible fashion, you're adding 60% to the cost because it takes $1.60 net of $1.60 less the taxes to have $1 left over to make the payments. So $1.60 times 40% is 64%, and 40 times 40% is 64%, and that's how you end up with $1. So using this example, going back to Charlie, where if we were to treat these intangible payments as stock, and sometimes I've even seen the tangibles treated as stock, even though they're pre-tax assets, the effect of the non-deductibility is about $83,000 a year. So again, in Charlie's situation, this makes the payments unaffordable. All right, this is our last polling question. Sorry to put you through this, but we got to do it. Gretchen?
Okay, our fourth and final polling question. I believe our approach to valuing our owner's interest in the firm is fair and affordable. Fair, but I'm not sure we can afford the buyouts. Not fair, too high. Not fair, too low. And not applicable, we don't have an agreement. Okay, I'm going to go ahead and close this poll. We have 42% say not applicable, we don't have an agreement. 25% each for fair and affordable, and fair, but I'm not sure we can afford it. And 8% for not fair, too high.
Okay. Nobody thought it was too low. So we don't have any of the older partners.
Nope.
Okay, so we've kind of talked about why it might seem unaffordable, even though it seems like it's fair. And if you still think it's fair after going through what we've just gone through, then your problem might be succession. But anyway, if you need help with it, obviously we're here to help. Okay, so the next issue that can create a problem is partners with very high productivity. I kind of gave you a brief example of that earlier. Let's say Charlie's doing 1,800 billable hours instead of the 1,300. And in this case, the replacement cost gets pretty high. Therefore, the residual is too low. And, we probably need to address changing the deal, probably in actually, quite frankly, in terms of bringing down the multiple, because too much of the work's being done by the partners, and so there's not as much value that's being created for the firm. All right, let's talk about transition issues and how they affect your owner agreement. So the things that you can have here are an inadequate notice period. I've seen too many agreements that have no notice period required. In other words, a partner can walk in and say, I'm resigning, or I'm retiring, and you owe me, whatever the agreement says. I've seen lots of agreements that have 90 days. And typically what's happening here is that the firm and the firm's attorney, who probably drafted the agreement, haven't thought through the business issues. They thought more in terms of, well, this is what we used in a client that had a manufacturing company. It seems odd, like it should work in this case as well. Not understanding that the value of the firm is so important, is so ingrained in the relationships that the partners have with clients and with other people, that a sudden loss of that person can have a devastating impact on the firm. Another problem is when even though you might have an adequate notice period, and adequate to me is normally 2 years or longer, even though you have that notice requirement, there's no teeth in it. There's no consequences if we don't do it. So you're left kind of, well, now what? And you can assume, well, that means they can't retire and they get nothing, which doesn't make sense. Or, we don't know what happens. And so usually we will try to define the consequences of no notice. A typical consequence might be a specific reduction in value say no notice results in 50% of the value that would be otherwise. A notice of 1 year and not 2 makes it 75%. Those are examples. Or you, in some cases where you have people that have pretty distinct books of business, you can tie any loss of business within their book of business, or even in the whole firm as a whole. Any loss of business would result in an adjustment in the buyout, even though that's not how the agreement is written otherwise. Another problem we run into is lack of aggressive transition plan or no teeth in the transition plan. So I remember one of the first, when I first started doing this 15 years ago, I did a partner retreat and we talked about all these issues, and the partner said, our problem is, the managing partner, our problem is that, our partners don't transition, even though they're supposed to, and they give us notice, nothing changes. And so we still have a problem with losing clients. And I came away with, what should we do? And I didn't really have a good answer for him, but I came away from that knowing that building a specific written transition plan needs to be part of the agreement, a requirement to have a written transition plan, and that the plan be executed to the satisfaction of the firm should be a part of the agreement. And a failure to do that would be the same treatment as not providing notice. And so that's generally what I recommend nowadays. And I actually oftentimes will give my clients an example of that written transition plan. If you'd like to have a copy of that, just let us know through, send me an email and say, hey, I'd like to see a copy of a generic transition plan. I'd be happy to send it to you. And then, of course, I've seen too many agreements that are based on, retention of clients from the outset. So we have a book of business. We say we're going to pay you based on what we keep in that book of business, and that's going to be your buyout. The problem with that is that both sides in that transaction tend not to deal with transition in a proactive way because they don't have to. We'll find out what happens, and hopefully good things will happen if they don't, we're covered. So I really don't recommend agreements that are based on retention unless it's a very special situation. So the ideal plan, as I said, would have a 2-year notice period, an aggressive transition plan that's written, that deals with any ongoing role, including client management and also other than client management, and consequences for inadequate notice or transition execution. Let's talk about mandatory retirement.
Terry.
Yeah.
Excuse me, Terry, you do have a couple of questions. I didn't know if you wanted a chance to get to those.
Yeah, I didn't see them. Are they up here?
They're in the question block.
Yeah, I'm not seeing those. Can you read them off to me?
Sure. The first one is, what multiple of billable time is generally used of retiring partners who are continuing to work for the firm after selling their interest?
We usually recommend between 33 and 40% of the billing rate for billable time. And then if you ask them to do administrative duties and they are specific, not just the normal, like attending CPE or, filling out your timesheet and all that kind of stuff. If you have a specific duty, for instance, you're going to teach CPE, or you're going to be involved in recruiting and those kind of things, then if you want to put an hour, either set a specific amount of compensation for that, or if you want to use an hourly compensation, I'd usually recommend 20% for administrative duties. What's the other question?
The other question is, how do you factor in client retention?
Okay, again, the assumption here is that if you get adequate notice and you execute a transition plan, 2 years of adequate notice, and 2 years of execution of this transition plan should be enough that you don't have to factor in client retention. An exception to that would be where you have a specialty practice where it's not certain that we're going to be able to overcome this particular partner leaving. Maybe the relationships are too personal. Maybe his or her specialty is so specialized that we're not certain we can replace it. In those situations, I probably would recommend some retention, an adjustment based on retention. The other circumstance, of course, is if they don't provide notice or they don't execute the transition plan, then you definitely want to have retention be a part of determining the buyout if you don't use a specific discount. But otherwise, I don't recommend client retention be the basis for your agreement, because I think that you should have instead a strong business plan for transitioning duties and retaining clients, so that the day that that partner retires is a non-event for the clients. They know who their replacement is. They've been working with that person, and all they're doing is saying good luck. We really enjoyed knowing you over the years. Okay, so mandatory retirement. This has become I'm going to jump ahead here. This has become a very important part of most agreements. Within the Rosenberg survey, 88% of firms that are 20 million and higher have mandatory retirement, 72% between 10 and 20 million. The reason why is because this creates capacity within the firm for the next generation. When we do mergers, upstream mergers, and we've got firms that have partners in them that are in their mid to late 60s, and they have an uncertain time frame for when they want to retire, they're very difficult to find a home for these days. Normally, some firms won't even talk to a firm like that if they've got other options. But in most cases, they want certainty as to how long that partner is going to be around, and it's probably not going to be more than a couple of years. So this is an important issue in larger firms. It should be an important issue in your firm. If you have the ability to replace partners, you've got to create space and capacity for the next generation. You also need to avoid hangers-on. I mean, people that are, they're 70, 75, whatever. It has nothing to do with their age, by the way. I mean, they're very vibrant people of that age, but the issue is if they start slowing down, they start not really participating, and they're not helping the firm grow. They're not doing what they used to do, but they expect to get paid like they were. That's a common problem we want to avoid. So normally the certainty that comes with a mandatory retirement age is that I know Joe is going to be retiring at age whatever, and normally that's between 65 and 67 nowadays. And so I can plan for that. Even though 2 years might be adequate time to execute a transition plan, it's not adequate time to develop the partners to replace Joe. We usually we want to have somebody in place normally about 4 years ahead of retirement date in order to make sure that they're in a position where they're ready to execute in an aggressive way that 2-year transition plan. So I gave you the examples here of the mandatory retirement firms that have that. And the average age right now is 66. What I'm seeing most often is 65, Social Security retirement age, or 67. Mandatory retirement ages that are at 70 or higher, in my opinion, are basically ineffective. That's just saying, well, we're paying lip service to it. We're not really going to have a mandatory retirement age. Okay, so what are some of the other issues? We've got 6 minutes left here. We'll go through them fairly quickly. Personal guarantees. When I see buyouts, this oftentimes happens when you have founding partners that own a high percentage of the firm, and they want a personal guarantee from all the other partners that they're going to get paid. I highly recommend you not include that in the buyout for a variety of reasons. The biggest one is that it's hard sometimes to get new partners to become partners in the firm if they're going to sign a personal guarantee for buyouts. You've got partners that also have varying amounts of risk associated. So you got one guy whose wife is, for whatever reason, is worth a lot of money or making a lot of money, and somebody else whose wife doesn't even work or husband doesn't even work. And those two people, that personal guarantee means something entirely different to the two of them. So personal guarantees, I usually recommend they not be used. Vesting is an important part of bringing in new partners. The idea of vesting is to make sure that the team that you've assembled to buy out retiring partners stays intact in order to accomplish that goal. It's especially important with firms that, those of you that are in the 2 to 4 range of partners, this is very important because, loss of one person can have a devastating effect on the ability of the firm to sustain itself. You can't make people stay, but you don't want to reward them for leaving too early. Consider that death and disability is no different than somebody really quitting suddenly. And so, with death, you want to make sure you've got insurance that backs up the buyout if you can. Disability is a little harder to deal with. And, if you're not comfortable that a person that becomes suddenly disabled is able to, that you can replace them and sustain the business, then you maybe ought to consider permanent disability the same as somebody quitting without notice. On restrictive covenants, I usually recommend, and of course this is a state-by-state issue and a lawyer-by-lawyer issue, so I tend to be pretty aggressive with restrictive covenants, and some lawyers push back. I'm not a lawyer, so it's up to your lawyer to decide what you do. But I recommend that you have at least a 2 to 3 year period post-termination where a partner who's going to get paid buyout payments is not in a position to compete with the firm in any manner at all, and that you should have a restrictive covenant that covers not taking any clients for at least the period of time that the buyout's occurring. So you don't have somebody, taking clients while you're still paying them for the clients they left behind. I don't recommend normally that you allow partners to take clients from the firm. Some firms feel like, hey, we each built our books of business and we want to be able to walk out with them. I think basically everybody's a free agent at that point. So I think that's a hard firm to sustain, and I don't recommend you allow it. Right of first refusal agreements don't make any sense at all to me, but some attorneys use them. And I'm afraid we won't have time to go into personal goodwill for corps. If you want to know more about that, let me know, and I'll get into more detail with that to deal with your situation. So the equity system is one that is commonly used with smaller firms. The compensation system is one that's used in larger firms, and then there's a third system, the AAV system. And I'm not going to have enough time to go into it in detail here. There's an article that we wrote for the Journal of Accountancy that you can download from our website that's called Admitting New Partners, A Fresh New Approach. There's a link to that in this back in the next few slides. I'm going to talk about the AAV system for a second here. So the traditional approach to bringing in new partners is that we are, in essence, we treat it as if we're selling a portion of the firm to that partner. So the firm's worth $3 million. We want this partner to say $3 million for intangibles and then another $750,000 for tangibles, so a total value of $3,750,000. If we're going to sell somebody or allow them to become a 10% partner, shouldn't they pay $375,000 for that? And a lot of you may have gone through that kind of buy-in to get into your firm. So that's it's typically how we think about this, but there's a number of reasons why it doesn't work. So an example, again, I just went through. Even if we allow them to pay over 7 years, that's $50,000 a year. And that means that we've either got to increase their compensation substantially in order to cover that, in which case they're not going to make any more money for those 7 years, or they're going to go backwards in compensation. So it tends not to work very well. The conundrum is the cost of the new partner. What's the right amount of compensation to allocate in order to justify the buy-in? How much should they invest? And how do you deal with acquiring more equity down the road? So this AAV system is where we convert the firm's volume to units. If we have a $6 million firm, we create 6 million units. We price those units at a desired revenue multiple. And if we're using an 80% revenue multiple, we'd say 80 cents per unit. And we allocate the units based on a variety of methods, but usually performance-based. And so when a partner buys in at the beginning, we usually don't allocate any units to them, and therefore we don't ask them to pay anything for them. And where they earn their units is through sweat equity, either by being allocated a portion of the growth that occurs after they become partners, or by buying out retiring partners. So again, you'll get into, it's hard to get into a lot of detail. I've done whole webinars on just this very issue, But I recommend that if you're interested in an alternative approach, and especially if you're trying to convert from the equity system to something else, that you consider looking at that article and consider the unit system as a way to go. Here's the example of some additional webinars that you can look at that we presented last year and the year before that have videos associated with them. You won't get CPE if you view them, but you'll get the information from them. And then here's some example of articles that are on our website. We probably have, I don't know, 50 articles on the website that we've written, mostly for the Journal of Accountancy and other trade association publications. And with that, I'm going to skip through this. This is how you get a hold of me. If you have any questions, I'm happy to answer them. Gretchen, that's it. I think we've made it right on 1 hour.
Okay, I'd just like to remind everyone that along with answering the 4 polling questions, you must complete the evaluation that will appear right after this webinar is over to get the full 1.2 CPE credits. And thank you again for joining our webinar, and enjoy the rest of your day.